Welcome to CPA Australia's live webinar. Presenting today, we are joined by Ram Subramanian and John Purcell. Supporting in the chat box, we're also joined by Michelle Webb and Kimberly O'Hayan. Now, I'm just going to welcome our presenters into the conversation, just opening up your mic there. Good afternoon.
Good afternoon.
Good afternoon, everyone.
Thank you, Linda. This is Ram Subramanian here, and my colleague Dr. John Purcell will be speaking soon after I finish my update. I will probably take another 25 minutes or so to cover my areas that I wanted to update on, and I will then hand over to John for his section, and we would hopefully have around 10 minutes at the end of the session for Q&A. So if you could perhaps keep posting your questions on the chat box as you go along, we will get a collection of those questions and we will try and address as many as we can during the course of this webinar. Now, just a brief overview of what we do in the policy and advocacy team at CPA Australia. Both myself and John are members of the policy and advocacy team at CPA Australia. My area is financial reporting, and John covers ESG, environmental, social, and governance, and as part of that, he covers various external reporting matters such as integrated reporting. I don't want to take away, steal John's thunder, so I'll stop there in terms of what John does. I'll probably focus on my area for the rest of this, my segment of this presentation. On that slide you see there, you'll just see a snapshot of the kind of things we do within the policy and advocacy team. So a broad-based approach to a number of different things. Primarily, we are here to advocate on behalf of members on a number of different issues. In my area, as I go through my presentations, you will see the type of policy work that we do in the form of submissions and other things. So I'll skip on to the next slide. So this is just a snapshot of today's topics. So I will pick up and cover a very brief International Accounting Standards Board update, followed by a public sector update, primarily based on the work of the International Public Sector Accounting Standards Board, and then a very, very brief update on joint monitoring group activities. And that is more in the area of audit than in the area of financial reporting, but that's a very short, brief update. Following that, I will hand over to John for his update on his areas of expertise. All right, so what's happening in IFRS world? I thought I'll just cover a few issues relating to standards that have already been issued, and some of the implementation work and some of the additional work that the Accounting Standards Board, International Accounting Standards Board, is doing in that space. And the first one I'll just pick up on is not actually on the slide. It is an amending standard that was recently issued by the IASB. It's on something called IBOR reform changes. That's the interbank offered rate. And some of you may be aware that there's a global push to reform how IBOR rates are set because there have been some challenges in the past and questions raised around manipulation of IBOR interest rates. And for that reason, there is a global push to reform how IBOR rates are set. Now, that has an impact on accounting. And the impact is primarily, as you would expect, in the financial instrument space, so IFRS 9, IAS 39, and IFRS 7. Now, this particular amendment is only what I would call a narrow scope amendment. So what that basically does, it affects how you use interest rates when you're doing hedge accounting. So hedge accounting itself is obviously a specialized area within the financial instrument space, and this specific amendment looks at hedge accounting. So what this amendment effectively does is it freezes the interest rate that you've used in doing your hedge calculations, and any changes that may occur through the IBOR reforms can be ignored until the IASB makes further announcements in this space. So if you've got a hedge instrument and you've used an interest rate that is based on IBOR, effectively you're going to continue to use that interest rate even though there may be changes being announced or changes being considered to the interest rate. You wouldn't do any changes to your accounting itself until the IASB makes further announcements in this space. So quickly moving on, I do have a fair few things to cover in my segment, so I'm going to go through it very rapidly, so bear with me as I do that. So I just wanted to give you a quick update on IFRIC. And for those of you who are aware, IFRIC is the International Financial Reporting Interpretations Committee, which sits alongside the IASB. The role of IFRIC is to provide interpretations and guidance on existing standards. And this is effectively to address any practical accounting challenges or issues that have been raised post the issue of a standard. Now, one thing I specifically wanted to touch on in relation to IFRIC is not so much the interpretations they issue. Interpretations are, they have the same weight as standards do. So I'm not touching on interpretations. What I did want to touch on is something called agenda decisions. IFRIC regularly issues agenda decisions, and believe it or not, there are over 200 agenda decisions that have been issued by IFRIC since 2002. And I'm just going to touch on a couple. And some of you who work in the IFRS and financial reporting space may have already come across these agenda decisions. They are considered guidance. They're not authoritative in that they're not mandatory, but the IASB and IFRIC's view is that preparers should really refer to agenda decisions when preparing financial statements. So they have some kind of a quasi-authoritative status. So I'll probably just pick up on a couple of recent agenda decisions just to give you a flavor for the kinds of things that IFRIC considers in this space. So the first one I'd pick up on is to do with IFRS 15, revenue from contracts with customers. And a question was put to IFRIC around initial application fees received by a stock exchange when a company is looking to list on a stock exchange. The question was whether the initial application fee should be recognized upfront or over the course of the period when the company is listed on the stock exchange. The IFRIC considered this particular question, and they looked at what performance was being provided by the stock exchange in exchange for that initial application fee. And effectively, they concluded that apart from listing the company on the stock exchange, the stock exchange wasn't providing any additional services for the initial application fee. So they then therefore assumed, concluded that the application fee was effectively for the duration of the time the company was registered or listed on the stock exchange, so the initial application fee would be recognized over that period. Another example, very quickly, is on compensations paid by airlines for delays or cancellations of flights. The question in that scenario put to the IFRIC committee was if an airline has a legal obligation, so there's a law that says that the airline has to pay a penalty or a compensation to the customer if they cancel or delay a flight. Would that be considered variable consideration under IFRS 15? And of course, if it is variable consideration, it would be a deduction from revenue, or would it be a provision under IAS 37? And in that scenario, IFRIC concluded that it would be a variable consideration type arrangement, and it would be a deduction from revenue and not subject to IAS 37. So that gives you a flavor for a couple of things that IFRIC have recently looked at. Now, at the end of this slide, there is a link to a compilation of IFRIC agenda decisions for 2019. So this is the first time that the IFRIC have issued a compilation of this nature. So please do click on the link and have a look at the types of agenda decisions that are included in this compilation. The two that I've just talked about, just to give you a flavor, are included in the compilation. Very quickly moving on to the next item, I just wanted to quickly cover on IFRS 16 and one particular area, which is lease incentives. Now, there is a general view that IFRS 16 doesn't adequately address lease incentives. And we at CPA Australia hold that view also. So we've been interacting with IFRIC previously and subsequently in the IASB. And in fact, we've made a submission to the IASB requesting that they consider providing further guidance on lease incentives. In particular, we've raised three issues. The first issue is to do with whether lease incentives are, what to do with lease incentives in relation to leasehold improvements. So if a lessor pays a sum of money to the lessee and says, here's a sum of money, you can use it for fixtures and fittings in your new premises. Would that be a lease incentive or not? The standard itself isn't very clear on this particular question, and so we've raised that point with the IASB and asked the question: would sums of money paid by the lessor to the lessee constitute lease incentives if they are for leasehold improvements? And the answer is, it depends. If it's for the lessee's benefit, the answer is yes. If it's for the lessor's benefit, then probably not. And a couple of other questions we've raised as well, where we believe that there is insufficient guidance. One of them relates to lease incentives paid by the lessor to the lessee after the commencement date. There is some ambiguity around how you account for lease incentives paid after the commencement date. And the last question that we've raised with the IASB is around transition. So under the old standard, IAS 17, you had an IFRIC interpretation looking at lease incentives, IFRIC 15, I believe, and that particular IFRIC interpretation provided guidance on how to account for lease incentives. Now, on transition, you may have lease incentive balances brought forward. The standard IFRS 16 doesn't necessarily tell us how to account for those balances brought forward on transition. Have a look at our submission. It's on our professional resources webpage, and if you click through to our submission, it not only provides the questions, it also provides some suggestions as to how the answers could be framed for those particular questions. So I will stop there on lease incentives and very quickly update you on IFRS 17. As you probably know, IFRS 17 was recently issued, the last major standard issued by the IASB. It's on insurance contracts, and a lot of people believe that it only affects insurance companies. Probably true, it definitely affects insurance companies, but be mindful that it will also potentially affect any companies that have insurance contracts as part of their operations. So there may be some groups where there are companies within the group that are used just for insuring the risk across the group, and that kind of a company may have to be subject to IFRS 17 insurance contracts. Now, currently the commencement date for IFRS 17 is 1st of January 2021, but there is a suggestion that that's going to be pushed to 2022, and there is even a question mark whether it should be pushed to 2023. But we'll have to wait and see. We would definitely support pushing it back to 2022 because we believe there's quite a few questions that still need to be addressed, and perhaps to 2023 as well. But we will wait and see where the IASB goes with that. I very quickly wanted to touch on accounting for cryptocurrencies. This is an issue that the IASB considered whether it should pick up and run as a project, and the IASB has currently concluded that it will not do that. So the IASB doesn't have a project currently on accounting for cryptocurrencies. However, IFRIC has considered the issue and has effectively concluded in an agenda decision that cryptocurrencies would either be accounted for as intangible assets or as inventories. Interestingly enough, cryptocurrencies don't meet the definition of financial instruments under the current definition of what a financial instrument is, and it doesn't necessarily meet the definition of cash either under the IFRS literature. So IFRIC have concluded that it should either be accounted for as an intangible asset or as inventory. I suppose it would probably be accounted for as inventory if cryptocurrencies are frequently held and traded in the normal course of business. Otherwise, it would be accounted for as an intangible asset. Quickly moving on. Here's a couple of projects that the IASB is working on, which I would consider major projects. The first one is primary financial statements. So this is effectively looking at the income statement or the profit and loss account and a few other related matters in relation to the income statement. The first thing I'd probably mention in relation to the primary financial statements project is that the IASB is looking to include new subtotals in the income statement. Now, many of you may be aware of subtotal lines like EBIT, EBITDA, operating profit. These are all lines that are commonly used in income statements, but they're not actually IFRS-based numbers. So they're what you would normally refer to as non-IFRS or non-GAAP numbers. So the IASB is looking to incorporate some of these commonly used subtotals into the income statement. So currently they're proposing three new subtotals: a new subtotal line for operating profit, a new subtotal line for operating profit and share of profit or loss of integral associates and JVs or joint ventures, and lastly, profit before financing and income tax. In addition to that, in addition to the subtotals issue, they're also looking at the question of aggregation and disaggregation of numbers in the financial statements. One of the things that you would probably come across as an accountant is that where people are unable to allocate a particular expense line item to a particular type of expense, you put it in the other expense line. Well, that's one thing that the IASB doesn't want to see. So you don't want to see this huge other expense number or other income number even, and rather you will try and break it down into the relevant expense or income lines as appropriate. The other thing that they want to address, the IASB wants to address as part of this project, is unusual items. So we as accountants once again have come across things like exceptional items and extraordinary items in the past. The unusual items area is looking to address and recognize unusual items in a particular way. So this is one of the issues that the IASB is going to consider as part of the primary financial statements project. Lastly but not least, management performance measures. So these are non-GAAP measures or non-IFRS measures that you would see frequently in the notes. So the IASB is looking to address these types of measures through this project as well. Quickly moving on, very quickly, I'll cover impairment and goodwill, which is another major project being run by the IASB. Very quickly, I will just cover a couple of major decisions that the IASB is looking to make in this space. One, they don't plan to introduce amortization of goodwill. Some stakeholders have asked the IASB if that's something that they would consider. So introducing some kind of arbitrary amortization of goodwill over a particular period of time, and the IASB has said no, they're not planning to do that, and we at CPA Australia would agree with that. I don't think goodwill can be subject to amortization. Impairment is the way to go for goodwill. However, one of the issues that the IASB has identified is that annual impairment is both expensive and can be challenging. So for that reason, the IASB is looking to make the impairment process easier and simpler. So one of the things that they're considering as part of that is to maybe not require annual impairment of goodwill, and perhaps doing it only when indicators of impairment exist for goodwill. So that's a couple of things that maybe just need to be aware of as we look at what the IASB does as part of that project. Finally, on the IASB slide, I just wanted to quickly touch on subsidiaries that are SMEs. So this is like a tier 2 project. For most of you who work in different jurisdictions, for example, those of you who are in Australia are probably aware of something called the RDR framework, or the Reduced Disclosures Requirements framework. So effectively using the full IFRS literature, but reducing disclosures for entities which do not have public accountability. So your non-listed large corporates and other similar entities. So the IASB has picked this up as a project, and they're looking to introduce a framework of reduced disclosures, and this is reduction in disclosures only, not in recognition, measurement, and presentation requirements, only disclosures. So they're looking at the IFRS for SME standard as a basis for reduction in disclosure. Interestingly enough, the IASB is already running a project, their Simplified Disclosures Project, which is currently open for consultation through Exposure Draft 295. And the IASB is literally looking at what the IASB, the Australian Accounting Standards Board, is doing in driving their own project forward. So if anyone's interested in what this project might look like in the future, have a look at Exposure Draft 295. Very quickly, I'm going to, by the way, there's the link that I mentioned to the IFRIC Agenda Decisions compilation, so please do have a look when you get a chance. I'm going to very quickly rush through the IPSAS developments. I'm conscious that I want to hand over to John. I'm sure you're very keen to hear what John has to say. So very quickly run through my IPSAS update, the public sector update. Public sector financial instruments, these are financial instruments specific to the public sector. There is an open consultation at the moment, which is closing on the 31st of December this year. They're looking at things like monetary gold. So certain jurisdictions hold gold as a reserve value, and governments hold gold. So the question is, how do you account for that? And other things like currency in circulation as well. How do you account for that? Effectively, this ED 69 is looking at producing guidance for the accounting for these public sector specific financial instruments. And effectively, the conclusion is, yes, these are financial instruments and they would be accounted for in accordance with the normal way in which you account for financial instruments. We have not picked up anything major or significant in respect of these particular proposals, so I will quickly move on to revenue without performance obligations. Now, very quickly, with revenue without performance obligations, there are two EDs that are going to be exposure drafts that are going to be put out by the IPSASB very soon. Exposure draft 70, which will be looking at revenue with performance obligations, and exposure draft 71, which is going to be looking at revenue without performance obligations. The distinction effectively is that when there is revenue generated by a government entity, sometimes they have to provide something in return for it or perform something in return for it. In other cases, they don't. For example, where they receive a grant and there are no specific performance obligations in relation to that. Just a very quick snapshot on what that relates to. The other project which is probably related to the revenue project is the non-exchange expenses project, which is the other side of revenue without performance obligations. So that's going to be an exposure draft on that expected sometime next year, exposure draft 72, which will be after 70 and 71 issued by the IPSASB. Heritage is another major project that is being currently run by IPSASB. They did put out a consultation a little while back, and they're still continuing to debate how to account for heritage assets. It's quite a challenging area, well, I must admit. So how do you account for if the Louvre holds the Mona Lisa? How do you account for that on the Louvre's financial statement? How does the Great Wall of China get accounted for? Is Mount Everest a heritage asset? So these are the kinds of questions that come up as part of this project. And what the IPSASB have concluded so far is that there are assets which would be considered natural assets. So Mount Everest will probably come under that category, and they're going to consider that as a separate project. At the moment, they're only looking at man-made heritage assets, which would be the likes of Mona Lisa and the Great Wall of China. And they're also looking at different aspects of heritage assets, including is the the holder of the asset the actual owner of the asset, or are they only stewards holding it on behalf of the community at large? For example, a museum that holds a particular heritage asset might only be holding it on behalf of the community. They may not actually own the asset. The other question is the heritage asset used in the normal course of daily activities or not? So a painting on a wall may not be used in the normal course of daily activities. The Sydney Harbour Bridge, on the other hand, one would consider is a heritage asset, but is also used as a bridge. So how do you account for those, and what are the distinctions? So these are the kinds of issues that are being considered as part of that project. Quickly moving on to leases. IFRS 16 has obviously been issued by the IASB, and the IPSAS is now looking at its own version for the public sector. And the biggest difference that they're looking at in the public sector is to mirror lessee accounting for lessor accounting as well. So of course, under lessee accounting, everything goes on the balance sheet. Pretty much everything goes on the balance sheet, I should say. IPSAS is considering the same approach for lessor accounting as well. So that might be a big change if that does come through for the public sector. Quickly, measurement was a consultation that was issued earlier this year. CPA Australia and Chartered Accountants ANZ jointly put in a submission in response to that. We've basically asked IPSAS to go back to the drawing board a little bit and try and work a little bit more on this particular project. Measurement is looking at a range of different measurement issues, including fair value, historical cost, replacement cost, and other things that you commonly find as measurement principles or basis in the public sector. Very quickly, as I mentioned, I've finished my IPSAS B update. Just quickly move on to the Joint Monitoring Group. To be frank, nothing much has happened in the last year or so in this space. This is basically looking at moving the International Auditing and Assurance Standards Board away from the IFAC model, the International Federation of Accountants model, into an independent body. Something similar to what the IASB is like these days, the International Accounting Standards Board. So that project was kicked off about 5 years ago. In the last year or so, there hasn't been much movement. There has been some movement in the Joint Monitoring Group itself in terms of leadership, but I won't go into exactly what kind of changes that have happened in that space. I'm conscious of time. I'm going to now pass on to my colleague, Dr. John Purcell, for his very, very interesting update. Over to you, John.
Thank you, Ram. What I want to address in the time available to us this afternoon is the subject matter of climate change, one of the significant areas which falls under the broad theme of environmental, social and governance policy. I will address some aspects of climate change policy, particularly the international dimension of climate change policy and its interaction with national policy. I will look at the nature of emissions reduction actions and significantly want to set much of this in the context of the implications for accountants. A significant part of development in this area, particularly from a reporting and disclosure perspective, is driven by the Financial Stability Board's Task Force on Climate-Related Financial Disclosures, in brief, the TCFD. One of the themes I will stress further is that these international developments, the international framework produced by the TCFD has very direct ramifications and take-up in a number of regulatory instruments and governance frameworks that operate within both Australia and other national jurisdictions. Firstly, addressing climate change policy. The United Nations Framework Convention on Climate Change at its 21st Conference of Parties was held in Paris in December 2015. It follows on from earlier conferences of parties, particularly that in Kyoto. As at present time, there are now 185 parties, essentially nation-states, who have ratified the Paris Agreement. I'll delve into some of the technical aspects of the agreement. Please forgive me, it is a little bit structured as a legal document, but it has high relevance in terms of understanding how it translates to national policy and actions which affect business, the economy, and where accountants sit. Article 2 of the agreement states its objective is as follows. The objective is to hold the increasing global average temperatures to well below 2 degrees Celsius above pre-industrial levels and pursuing efforts to limit the temperature increase to 1.5 degrees Celsius above pre-industrial levels, recognising that will significantly reduce the risk and impacts of climate change. I will address shortly some of the risks associated with climate change and why they have an economic and business implication of profound magnitude. Turning to Article 4, this links the constraints on global warming objectives with emissions reductions. These emission reduction objectives operate at a national level. It states, in order to achieve the long-term goal, parties aim to reach global peaking of greenhouse gas emissions as soon as possible and to undertake thereafter rapid reductions. Each party shall prepare, communicate and maintain successive nationally determined contributions that it intends to achieve. Parties shall pursue domestic mitigation measures with the aim of achieving the objectives of such contribution. Each party shall communicate a nationally determined contribution, in short, an NDC, every 5 years. So it is the NDC which forms the basis of national policies. Now, to repeat, each party shall communicate an NDC every 5 years. Significantly, 2020 will require each of those 185 parties to the agreement to issue an updated NDC or report on their progress in relation to emissions reduction. I want to address where this starts to have a manifestation in national objectives and national economic behaviour. Bear in mind that greenhouse gas emissions is a global problem, but it has at its base national economic activity. 10 economies contribute 73% of global greenhouse gas emissions. China, 23.7%, the USA, 12.9%, the EU, 9.6%, and India, 6.5%. Australia ranks 11th as the largest emitter of greenhouse gases, but nevertheless ranks 13th in overall terms. It is 11th in overall terms, but on a per capita basis ranks fairly highly at number 11, given the basis of our economic activities. The table that I show there gives some indications of some brief comparisons. Indicated Australia's contribution to global emissions is 1.3%. Compare that to the very low level of New Zealand at 0.1%. The second line of that table is illuminating in so much as it explains the sources of emissions contribution. You'll see for Australia, 35% is derived from energy generation. Hence, a lot of the Australian activities around emissions reduction is targeted at the electricity and the energy sector. Conversely, based on the economic structure of New Zealand, 50% of its emissions derive from agricultural activities. To repeat, per capita, Australia is at 18.3 tonnes of carbon oxide equivalent. Relative compared, though, New Zealand still is at a fairly high level at 13.2 tonnes of carbon dioxide equivalent. The Paris Agreement commitments. New Zealand's is relatively ambitious. They aim to reduce emissions by 30% compared to their 2005 levels, whereas Australia, its NDC is to reduce emissions by between 26 and 28% compared with its 2005 levels. Where do we stand in relation to current projections? The Intergovernmental Panel on Climate Change, their assessment states that current emissions reductions targets under the Paris Agreement will in fact not limit global warming to 2 degrees Celsius, let alone 1.5 degrees, and that avoiding temperature overshoot and reliance on future large-scale deployment of carbon dioxide removal can only be achieved if global emissions start to decline well before 2030. A couple of comments to make around that. In terms of carbon dioxide removal technologies, these are only at a relatively rudimentary level of development. The current projection is for global warming to be at 4 degrees Celsius by the end of this century. I want to address very, very briefly, identify some of the climate change actions being taken. Let me just give a quick sample of some of the actions that can be identified. 116 countries have some form of renewable energy target. However, the level of ambition varies greatly. In 2027, global investment in new renewable energy was $374 billion, and this far exceeds $145 billion invested in fossil fuel generation. 21 countries have implemented some form of carbon tax. Nearly 80% of new passenger vehicles sold globally are subject to fuel efficiency or CO2 emission standards. 30 countries have committed to phase out coal power that does not have technologies to reduce emissions. Finally, 36 countries have implemented some form of emissions trading scheme. In summary, there is a lot of policy action, but it is indeed of a fairly fragmented nature and indeed of uncertain impact. Climate change risk. What is it? How do we understand it, particularly in economic terms? This is a fairly useful diagram which originates from the Bank of England. It gives, on the left-hand side, our understanding of the categories of climate change risk. They fall into two broad areas: transition risk and physical risk. Transition risk, what is this particularly from an economic perspective? This is essentially the processes associated with decoupling economic activity from fossil fuel dependency. In the environmental sense, transition risk is associated with decarbonisation and the restraining of global warming. Physical risks are those which are both, as we'll see, chronic and severe. We'll have a look at those in a little more detail later. To look at this, however, in terms of understanding of economic and business behaviour, you'll see that these risks manifest very much, as an impact largely on the real economy. It affects firms firms affected by transition and firms which have physical assets or physical dependencies where physical risk is manifest or likely to manifest over time. Examples of which will be such as rising sea levels, affecting agricultural capacity, and increased uncertainty around rainfall levels. A lot of the activity we'll see from a policy sense actually works at the financial rather than real economy level. So what we are doing in terms of understanding business and economic impact is addressing the interactions of the finance economy with that of the real economy, and how behavioural change will take place and how that is underpinned by reporting and disclosure. The illustration from the UK, the Bank of England, though UK derived, it does have universal application. To repeat, it highlights the friction occurring in the interface between the finance economy and the real economy regarding both behavioural and disclosure response. This leads conveniently to discussion of the G20 FSB's Task Force on Climate-Related Financial Disclosures. Firstly, some background on the TCFD in terms particularly of the motivations. It is a hard-headed financial market-driven response, not necessarily driven by motivations and the desire to save the planet, though real. It acknowledges that financial markets and their link to the real economy need to be able to recognise and price climate change risk. It seeks to ensure that capital efficiently flows to long-term financial stability and generating financial returns, particularly, as we'll see, to institutional investors and large pension funds. Finally, the motivation, given that this has its basis in the activities of the Financial Stability Board, is to avoid financial shocks associated with the real threat of climate change. The TCFD propose 3 levels of response. They recognise that companies in their raising of capital are under disclosure obligations, both in terms of, say, for example, their annual reporting and in terms of their capital raising. We'll understand that financial disclosures are highly developed, but there is significant uncertainty as to how and at what point climate change risk should be recognised within financial accounting. Institutions, on the other hand, provide financial capital to companies seeking to raise capital. The manner of the TCF recommendations are very much around building the capacity for informed capital allocations and appropriate financial decisions that factor into their allocations the very real nature of climate change risk. Important to address the nascent state of non-financial or sustainability disclosures. Non-financial disclosures, such as those developed by the GRA, are well less accepted, and they do not necessarily capture a market orientation about them. What the TCFD is seeking to do is draw these forms of disclosure into a more coherent whole. Relevant also is the interest of regulators, particularly prudential and corporate regulators who are concerned in both market efficiency and the conduct of market participants, and to repeat, to ensure that risk is appropriately priced and capital allocated with the desire of efficient transformation. Noteworthy, the solution urged by the TCFD is to develop a clear, efficient and voluntary disclosure framework that improves the ease of both producing and using climate-related financial disclosures. I'll focus on one particular point, if I could, around the key innovations associated with the TCFD recommendations, and this is the second one. Should be addressed in financial filings. Now, although I've said that the TCFD proposes its framework as being voluntary, it strongly encourages the information produced finds its way into financial filings. That is the formal financial reporting, or the formal annual reporting of particularly listed companies to corporate regulators and to stock exchanges. You'll see therefore that a lot of the activity which is taking place at international and at national levels is driven from a quasi-regulatory soft law perspective. I want to address very quickly how we work into the relevance with financial impact. I've mentioned before that we have transitional risk. I want to focus on one area of transitional risk, that is policy and legal. Policy risk is associated with particularly government emissions reduction policy, which affects business behaviour. Legal risk is probably most directly associated with such things as shareholder litigation and hostile resolutions from shareholders at annual general meetings. Physical risks, to repeat my earlier comments, fall into acute, such as severe storms and forest fires. Chronic, however, is rather on a long-term sustained basis, most typical being rising sea levels and the sustained impact of global warming. I would stress that the corollary to risks are opportunities. Each of both risk and opportunity have a financial impact. The aim of the TCFD is to bridge that impact into appropriate forms of reporting, much of which is that which is familiar with accountants, income statements and balance sheets, so affecting our fundamental understanding of what is contained in financial statements. The TCFD recommendations are at 4 levels. It covers governance, strategy, risk management, metrics and targets. Focus very quickly on recommendation governance A. Describe the board's oversight of climate-related risks and opportunities. Wish to emphasise that the TCFD and regulators see this as a matter of paramount consideration to company directors. Want to address just a couple of the matters under metrics and targets. Disclose the metrics used by the organisation to assess climate-related risk and opportunity in line with the strategy and risk management processes. To stress again that there is seen to be a very strong link being drawn between corporate strategy, narrative disclosure and management impact, which finds its way through to financial disclosure. Finally, B, under metrics and targets, disclose Scope 1 and 2, disclose Scope 1, Scope 2 and appropriate Scope Scope 3 greenhouse gas emissions. These are derived from the Greenhouse Gas Protocol, a system of accounting for greenhouse gases, which is in common use. You'll find it in the reporting under the Climate Disclosure Project, the Carbon Disclosure Project, which many listed companies adhere to, the GRI, and is also the basis of reporting under Australia's National Greenhouse and Energy Reporting Scheme. The TCFD has developed a series of sector supplements. Just focus on two headline categories there. Banks in particular are noteworthy amongst the finance sector given their pivotal role, and energy within the non-financial sector, particularly given both the transitional and transformational risks associated with that particular sector, and hence its targeting particularly in national policy. I want to address now some national responses. This slide shows the outcomes of a survey conducted by ASIC, the Australian Securities and Investment Commission, looking at the level of the take-up of TCFD and greenhouse type reporting by listed companies in Australia. It is clear that this is an emergent level of practice at a very early stage. There is very low level of penetration down the ASX, below the ASX 100. Importantly though, the TCFD was often cited as the most useful framework referenced by companies who are starting to make these types of disclosures. We'll indicate now where this is feeding into national policy. I want to run through three particular areas of response which affect both corporate conduct, governance practices by companies, and ultimately effect on accounting decision making. Firstly, the ASX update of a number of its regulatory guides. Two regulatory guides which are affected by a recent update in August of this year. Regulatory Guide 228 Prospectuses, Effective Disclosures for Retail Investors, and Regulatory Guide 247 Effective Disclosures in Operating and Financial Reviews. So this is ASIC's guidance for company directors who are required to produce an operating and financial review under Section 299A of the Corporations Act. ASIC reviewed its guidance following the recommendations of a Senate Economics Reference Committee report on carbon risk and governance response, which encouraged ASIC to consider whether its high-level guidance on disclosure remained appropriate. ASIC has, I've indicated, updated its guidance to, amongst a number of things, incorporate the types of climate change risk developed by the TCFD into a list of examples of common risk that need to be disclosed in a prospectus appearing in Table 7 of RG 228 prospectuses. In RG 247, highlight climate change as a systemic risk that could impact an entity's financial prospects for future years, and that may need to be disclosed in an operating and financial review. Further, in RG 247, there's a reinforcing the disclosures made outside of the OFR should not be inconsistent with disclosures made in the OFR, drawing a close idea that discussion of climate change risk, if it is contained in the OFR, it needs to be matched with relevant disclosures in the financial numbers if that is the case. There's also made minor change to Info Sheet 304 info sheet 203, impairment of non-financial assets, material for directors to highlight climate change and other risks that may be relevant, determining key assumptions that underlie impairment calculations. You can see we are drawing ever closer to financial accounting considerations in a fairly formalised sense. The ASX Corporate Governance Council released earlier this year, its 4th edition Corporate Governance Principles and Recommendations. Significantly, there is recommendation 4.3, a broad change, though highly relevant. It states a listed entity should disclose to verify periodic corporate report it releases to the market that is not audited or reviewed by an external auditor. This gives a strong tendency to ensure that climate change disclosures ultimately are subject to external audit. Recommendation 7.4 has been significantly strengthened. A listed entity should disclose whether it has any material exposure to environment or social risks, and if it does, how it manages or intends to manage those risks. And their specific commentary reference is made to integrated reporting and the TCFD. I want to turn finally to an initiative from the Australian Accounting Standards Board and the Audit and Assurance Standards Board in their bulletin, Climate-Related and Other Emerging Risks, Disclosures Assessing Financial Statement Materiality using AASB/IASB Practice Statement 2. Now, Practice Statement 2 assesses the making of materiality judgments. Very briefly, Figure 1 in the AASB/AUASB Bulletin provides a very useful framework of analysis. It initially takes an investor perspective as to whether there is an expectation on the part of investors that there ought to be disclosures around climate change related risks, or whether the target of their investment is prone to such risks. This generates an assessment that needs to be made by the entity. The entity will make an assessment as to whether there should be a relevant disclosure in its financial statements, in its operating and financial review, or other narrative disclosures. If it does not make a positive assessment that these disclosures should be made, it will make a statement as to why it has not, what its assumptions are which support a non-disclosure. Further, even though there is not an expectation from the investors, a company must nevertheless make these types of self-assessment. Hence, going down the no path, there will be a consideration of the risks and the magnitude of those risks and whether they should be manifest in a form of disclosure. Finally, I would say that development in these areas is not at an end point. We'll see in 2020 further developments from the IASB around management commentary and from the IIRC in terms of its review of its integrated reporting framework. We look forward to these developments and communicating them to you. Thank you.
Thank you, John. Yes, we have one question and it's for Ram. I'll just read it out. It's regarding leases. They'd like to know more about how to account the ROU and lease liability at initial recognition when a lease contract contains a lease-free incentive. For example, the lessor provides the leasee a lease-free period within the lease contract.
Thank you, Michelle. The ROU is, of course, the right of use asset. Under the new model, under IFRS 16, any rent-free periods, which I presume is what the question's about, isn't actually meeting the definition of a lease incentive anymore, because what you've effectively got is a total amount of lease payments, and that excludes the rent-free period effectively. So when you calculate your right of use asset and your lease liability, you're looking at the total amount of lease payments, excluding the rent-free period. Therefore, you will be starting to recognize your rental expense from day one anyway through the amortization and through the interest charge that is being put through the income statement. So in effect, the answer is rent-free periods no longer qualify or no longer meet the definition of lease incentives because of the new model of accounting under IFRS 16.
Thank you, Ram. So we are conscious of the fact that we have reached the hour mark. We will just try one polling question. I know there were a few more in the slide pack, but we'll just try one. So Linda, I'm going to move through to the policy matters, the third poll.
Okay, no problems. If you just wanted to take us to slide 21, I believe it is, Michelle? Yep, one.
Yep. So we'll just try this poll quickly if you don't mind persevering with us for that. So how well are policy matters communicated by CPA Australia? So we're wanting you to select only one answer. So A, really well, you cover it all. B, adequately. C, ad hoc, needs to be more comprehensive. D, not sure. And E, not well. You've got 30 seconds to respond. If you can select one response and then click submit when you're finished. Thank you, Linda. So we've got 50% have said B, adequately, 16% C, 10% D, and 12% A. Do either of you want to respond to that?
Clearly, it's a positive message, but there's always room for improvement, and we'll continue to aim for that.
And expect our efforts to continue into 2020. Truly.
Thank you.
Thank you.
Well, that concludes the webinar for today. We apologise for going a few minutes over, but we'd like to thank our presenters for an excellent presentation. Thank you for attending, and we'll see you at the next webinar. Linda, I hand back to you to shut the webinar down.
Excellent. Thank you very much, Michelle. And I'll also say a special thanks to Ram and John for an excellent webinar. That does formally conclude today. So to exit, just click on that cross on the top right of your screen, letting you know upon exiting, you'll be automatically redirected to a feedback form. Now, the feedback form only takes about 30 seconds to complete. However, it's really, really beneficial for CPA Australia as well as our panel. So please leave us your thoughts. All right. On that note, I'll thank you very much, everyone, and I'll pop on the music as you all exit. Have a great day.